The RBA is expected to hold later today and then wait for inflation to soften so it can cut in February. Australia's housing market is heating up, but consumers are still cautious and job ads are falling. That's coming up in our 5 Things in 5 Minutes on Tuesday, November the 4th. And then in part 2 of our deep dive interview with Tatsuya Terasawa from Japan's Institute of Energy Economics, he describes the lessons others could learn from Japan's rare earths crisis of 2010.
In 2010, we learned a lesson, but no other countries paid attention to us. But now, many countries, including Australia, the US, are waking up to this issue.
But first, in 5 and 5 with ANZ, the Reserve Bank of Australia is expected to hold its cash rate at 3.6% when it publishes decision early this afternoon, Australian time. ANZ Head of Australian Economics, Adam Boyton, says last week's inflation surge of 1% in the third quarter means the next feasible chance for a final cut is February next year, after the release of December quarter inflation figures, possibly with a quarterly number of around 0.6%.
My expectation is that by the time we get to February, inflation will look more contained and that the Reserve Bank will probably take the view then that the economy could afford to run a little faster, given some of these emerging signs that we're just starting to see that maybe the strength in demand, activity, spending in the labour market isn't quite where it was a couple of months ago.
As of 4 a.m. Sydney-Melbourne time, the S&P 500 was up 0.1% and the Nasdaq rose 0.5%. The yield on the US 10-year Treasury rose 2 basis points to 4.12%. West Texas oil futures were up 0.3% at $61.17 US a barrel. Gold rose 0.6% to $4,019 US dollars an ounce. The US dollar index was flat. The Aussie dollar fell 0.2% to 65.35 US cents, and the Kiwi fell 0.3% to 57.07 US cents. Number 2, ANZ Research has upgraded its GDP growth forecasts for Taiwan for this year and next, after much stronger than expected tech exports, linked partly to the AI boom and partly to the launch of new phones, such as the iPhone 17. ANZ's chief economist for Greater China, Raymond Yung, is now expecting growth in 2025 of 6.9%, up from 6.2%, with growth next year of 3.9%, up from 3.5%.
We have already expected a very strong electronic flows and the global semiconductor supply chains. But the export performance in the last few months, even in the third quarter, was exceptionally strong, with the export rising almost 1/3 compared with last year. In some of the months, we've also seen more than 40% increase as well. And the export orders still very strong, and that's a leading indicators that point to even the fourth quarter of this year will still be pretty resilient.
Number 3, house price inflation in Australia has picked up in recent months, with Cotality data for October showing a 1.1% rise for the month, and annual inflation of 6.1%. ANZ economist Maddie Dunk says the smaller capitals of Brisbane, Perth and Darwin have outperformed, with growth of over 1.5% for the month. Even Australia's 2 biggest cities are heating up in the wake of rate cuts that started in February.
If you look at some of the larger capitals, Sydney and Melbourne, for example, we're seeing that prices have definitely recovered from where they were earlier in the year. So, for example, Melbourne housing prices were up 0.9% in October, but you're not seeing that growth that some of those smaller capitals are recording.
Number 4. However, consumers in Australia are not seeing quite such a rosy picture, with household spending data yesterday showing a softer than expected rise of 0.2% in September. That came as the ANZ Indeed job ad series reported a 2.2% fall in October. That's the 4th consecutive monthly fall in a row. Here's Maddie again.
We're seeing that volumes were up just 0.2% in the quarter for Q3, and that's the softest quarterly growth that we've seen in about a year. Now, some of that weakness is partly due to higher inflation. Some of it is due to the fact that we're seeing more people are looking at other means that are not legal to get tobacco and cigarettes, for example. But I think there's no doubt that we are seeing some softness in some of the spending data.
Number 5. New Zealand's housing market is showing some signs of life, with new housing approvals rising in September, says ANZ economist Matt Galt.
They increased 7.2% this month in September and 6.1% last month, and that put them about 15% over their average over the past year. So it's looking pretty positive. It's one of the more positive indicators and suggests that monetary policy is working as it always has.
Matt Galt there. Now, in part 2 of our deep dive interview with Tatsuya Terasawa from the Institute of Energy Economics in Japan, we talked about how China's restrictions on rare earth or critical minerals exports to Japan in 2010 have set the scene for the trade disagreements others are seeing now. So this was like a preview of some of the debates that we're only really now having over the last 2 or 3 years, partly accelerated by the United States making some strategic decisions about pulling some of their production closer to home, being more self-reliant on particularly manufacturing and materials for defense and for energy security. What sort of lessons can the rest of the world learn from Japan's experience?
The first lesson is that our response was focused exclusively on rare earth. But after rare earth, there was graphite, germanium, gallium, and so on. So it's not just a single critical mineral. You have to look at the whole vulnerability of the supply chain. So rather than being responsive, you have to be well prepared. You have to analyze your vulnerabilities and make your preparation. That's lesson number one. Lesson number two is that, well, we were able to reduce our dependence on Chinese rare earths, so nearly 90%, to less than 60%. But that's just for Japan. The global dominance of China is much higher. We are talking about a global market for rare earth or critical minerals. A single country's effort certainly will not be sufficient. In 2010, we learned a lesson, but no other countries paid attention to us. So it was Japan's efforts alone, so the impact was very limited. But now, many countries, including Australia, the US, are waking up to this issue. So now we are finally having a much more global efforts to address the problem. But the third lesson is that we focus too much on mining only. But mining is certainly an area of concern, but it is in the processing in which China dominates. So just focusing on mining and not doing the processing would just keep you vulnerable. So this is an issue that many countries are missing yet. And even for those countries who now understand processing is very important, it is very difficult to ensure the resilience in processing. Why? There are reasons why China is dominant in the processing, because they're competitive. Why they're competitive? One reason is that their labor standards or environment standards may be lax. That's one thing. But number two, they have economy of scale to drive down the cost. So they are competitive. And the third is that we used to have some of the players in the processing in Japan or the US, but all of them or most of them have exited. Why? Because this market of critical minerals is so small that it is subject to the price going up and down. And when the price goes down, many US or Japanese or even Australian companies just exit because they are concerned about their quarterly profits. So you need to have a long-term commitment to stay in the market. And I think one of the approach by China was that somehow they flood the market with its exports and drive down the cost and drive the competitors out from the market, and they dominate. This is a serious problem, and we don't have the answers, and that's the reason why we're having this podcast. But there are certainly several elements we have to put into place. Number one, as I described, we have to work together among the like-minded countries. No single country can make this happen. Number two, we need to have a long-term patient capital, maybe from the public sector, that will stay there to support the operation. And number three, we have to have trade measures to protect the markets when there is a flood of imports coming in. At least these three elements would have to be in place, and maybe they might not be sufficient, but at least we would have to start with these three elements.
Tatsuya Terasawa there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Tuesday, November the 4th. Catch you tomorrow with all the detail and analysis from today's rates decision by the Reserve Bank of Australia. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.